Right. Good morning. Uh, my name is Bobby Criswickham. I am the Public Affairs and Outreach Coordinator for Nebraska USDA Farm Service Agency, and it's my privilege today to welcome you to the 2025 Annual Guaranteed Lenders Training webinar. Thank you all so much for tuning in to this important training. We appreciate your partnership as guaranteed lenders who will help us deliver farm credits to our farmers and ranchers across the state of Nebraska. We appreciate your assistance in that effort, as I feel it's very important to our producers, especially given the environment we're in right now. So thank you so much for being with us today. We're going to move through a few slides here. Before we do that, I think we have the opportunity to share a little bit more information about who's going to be with us today. Justin, I want to note that I don't see control for the slides, so if you want to go ahead and advance them, that would be great. Oh, there we go. Okay, now I see it. Okay, so I wanted to provide everyone with the opportunity to understand a little bit more about the Microsoft Teams environment in this town hall setting. So as you can see, there's a few instruction here. The important thing to note is that you're not able as folks who are receiving this information to share your audio or video with us, but you do have the opportunity to ask questions through the Q&A part of the town hall meeting. So you can see at the top that there's a Q&A dot that you can click on, and that'll allow you the opportunity to type in your questions. In speaking with Kelly and Justin, it sounds like we'll be answering those questions at the end of the presentation today. So, as you have those questions, please type them into the Q&A section and we'll address them. Note that there is closed captioning available if you need that kind of assistance. Please also know that this meeting is being recorded and that we will be able to make a copy of this recording available to you upon request after the event. And then PowerPoint slides. So the things that we're going to review today, we did send out to you earlier today as a registrant of this webinar. So you should have received the slides and handouts via email this morning. If you did not, we can follow up with you after this event so that you can have access to those products as part of this training. Okay, so let's start jumping into the presentation. We wanted to talk a little bit about who you're going to hear from today. You can see me as the Public Affairs and Outreach Coordinator. I'm going to cover some important farm program information for you before we jump into the Guaranteed Lender training portion. Your Guaranteed Lending training specialists today are Kelly Woida. Kelly is a farm loan specialist based out of the state office here in Lincoln, Nebraska. And then your other trainer will be Justin Terry, and Justin also is a state office farm loan specialist, but he is in the field. He's based in our office in McCook. And so they will be covering the main portion of the guaranteed lending training today after I get through a little bit here on farm programs. Here's a little bit about the agenda. And as you can see, the top thing we have is a little bit of time with our State Executive Director, Hillary Miracle. And I think I did see Hillary jump on. So SED Miracle, if you want to come on camera and say a few words, we'd love to hear a little bit of a welcome from you.
All right. Thanks, Bobby. I think we're on camera and all the good stuff. Welcome, everybody. Very, very excited to be here with you all. And most of all, want to be able to say thank you for being partners to take care of our farmers and ranchers. I farm up by Albion. We're a 6th-generation family farm. Our 7th generation officially comes home in about a week as one of the boys graduates from college and is heading back, and the other that intends to farm with us is coming back in May. So excited to be officially with adults, not just kids, a 7th-generation farm here in a few days. So looking forward to that opportunity. We are very traditional Nebraska. We raise cattle and crops, row crops, corn, soybeans, generally some alfalfa. This year we tried some millet, so that was an adventure. My daughter does have some sheep, so we do a little bit in the specialty space, but not very much. We do have 5 kids at home, 1 left in the nest, and the rest are all grown up. So as we think about the guaranteed lenders and how important they are. It's really important to me also as I think about the future of our family farm. We started farming with an FSA beginning farmer loan and have utilized the guaranteed lender programs and all of that. So really excited and hope that you truly understand the importance of the role you play in helping people be a part of farming and ranching and how important that is in Nebraska. A couple highlights for you today is just to let you know I just got back from some training out in Washington, D.C. with some of our leadership and also from across the state. Nebraska is one of the leaders when we talk about guaranteed lending, and I'm very, very proud to share that with everybody. We're in the top group there. We also do a really, really good job of building those partnerships, and that's because of each and every one of you. We know even being here today, it takes time out of your day. We appreciate that, and we hope you know what a difference it makes. Probably just the extra thing I would add today is, as many of you have heard, we're a little bit low on our staffing. We've lost a few folks to retirement and other natural attrition. So we are a little bit low. So I have two asks of you. One, be patient with us. We may be taking just a bit longer on a few things than we have as we get into really January, February here in the heart of lending season for agriculture. We may be just a bit slower. So I would ask for a bit of patience, but on the flip side of that, I would ask you to continue the great communication that you all do. So if something is taking way longer than you thought it should, reach out, make that call. We'll be doing the same. We'll be really focusing on that communication and doing everything we can to be efficient and effective as we look forward to working with you. But we do want to just let you know that we may need just a little more patience than normal. So again, looking forward to working with all of you. Thank you so much for being guaranteed lenders and putting in the work to be able to serve our farmers and ranchers and make sure that we get as many programs out to them as we can and make as much lending available to them as is realistic. So have a wonderful training. Enjoy the holidays. Family, friends, I hope you get to spend a little time with them. Thanks so much. Have a great meeting.
All right. Thanks, SED Miracle, for joining us today and sharing a little bit of your background and other information before we get started. So as you can see, here's the rest of the agenda. I'm going to cover a little bit on farm programs again, and then we'll get you into your guaranteed lender portion of the training. I think as we roll through the slides going forward, I'm going to turn my camera off so that you can focus on the information that's on the slides. Okay, so as we move into the farm program part of our discussion today, as you know, there are two kind of sides to FSA, right? So we've got our farm program side, and then we've got our farm loan side. So the information under farm programs we felt would be valuable for you so that you can know some of the other things that are available to your customers through FSA on that farm program side. As I'm sure many of you know, we've been operating under the 2018 Farm Bill that expired. We've been operating under kind of year-to-year extensions. Some of those Farm Bill programs were tweaked earlier this year with the passage of the One Big Beautiful Bill. I think that was signed by the president in July. Commodity programs like the ag-risk coverage and price loss coverage program had some updates within the One Big Beautiful Bill. There also were tweaks to programs like the livestock indemnity program, the livestock forage disaster program. A couple of those main livestock disaster programs also received some attention as part of that One Big Beautiful Bill. Not only were they tweaked, but also they were extended, I believe, to 2031. So those programs are moving forward under that extension. The rest of the Farm Bill actually, that wasn't extended with the One Big Beautiful Bill, actually expired in September, so a couple of months ago. However, it was then extended to September 2026 under the continuing resolution that ended the government shutdown in November. So right now, some of those programs are going to go to 2031. Some are extended to the end of September in the coming year. In addition, from a funding standpoint, that same continuing resolution that funded much of the government through January 30th, 2026. So that continuing resolution that ended the shutdown extended much of the government funding through the January 30th. However, Department of Ag was funded for the remainder of the fiscal year. So let's talk a little bit about the main activity and some of the main programs that we're working on the farm program side. So the ag risk coverage and price loss coverage programs, as I'm sure many of you know, those are our primary commodity crop safety net programs available for kind of our main commodities in Nebraska, corn, soybeans, wheat, grain, sorghum, dryable beans all fall under ARC PLC, and it provides that financial assistance when actual revenue or price drops below a certain level that's been set as part of that program. We did process payments for the 2024 crop year in the fall of 2025. So just over this last month or so, those ARC PLC payments for 2024 crop year went out to producers. I don't have a public dashboard yet to share with you how much actually was distributed for ARC PLC to the state. You can find, though, the county level payment rates. They're published on the FSA website, and you can see here kind of the progression to get to those county by county rates for ARC. I will tell you that the price loss coverage program, so for producers who had selected PLC coverage for 2024, did not trigger a payment. However, under the ag risk coverage, so under the ARC, if producers did select that, there were some counties that did trigger for ARC payments for the 2024 crop year. Under the One Big Beautiful Bill, producers for the 2025 crop year, instead of having select ARC or PLC, they will automatically receive the larger of those payments for the 2025 crop year. So when we go to make those payments, which will be in the fall of 26 for that 2025 crop year, producers will receive the larger payment automatically of ARC or PLC. And then once we get to looking at the 2026 crop year, producers will have to make an election or make a choice between ARC or PLC on a crop by crop basis for their farm. Other things that we're working on, the livestock forage disaster program, which is our kind of main financial assistance program to eligible livestock producers who have pasture land that's been damaged by a qualifying drought during the normal grazing season. This main program actually did trigger in 55 counties earlier this year using the U.S. Drought Monitor as the trigger. So for producers that are in those counties, and you can kind of see here the highlight of the counties that triggered this year. For producers that are in those counties, if they haven't worked with their county office to sign up, they have till March 2nd of 2026 to sign up for the 2025 LFP. So contact your county office, have your customers contact their county offices if they haven't already worked with them on this LFP for 2025 impacts. I also wanted to call out the Marketing Assistance Loan Program. So Marketing Assistance Loans allows producers to receive some financing to meet cash flow while they hang on to that commodity that they just harvested. Maybe wait till they feel like prices come up to a point where they find it a little more palatable for them. They do have to have beneficial interest in the commodity when they request that marketing assistance loan from us. We are seeing a lot more activity in our county offices with producers inquiring and wanting to access the marketing assistance loan program. So our offices are busy working with producers, especially if they want that marketing assistance loan for the proceeds to come yet this year. I mean, we're kind of getting down to the end of the year, so we really need producers to contact their county office right away if this is something that they want to take advantage of in this year yet. Also, and probably the biggest part of my farm program conversation, will be talking about ad hoc programs because we've been really busy through the whole year working on these. The supplemental disaster assistance that was offered through the American Relief Act, which was signed into law late in December 24, gave USDA $30 billion to deliver for disaster assistance to producers across the United States. The new administration is responsible for this implementation, so we've been working hard with rolling out these programs. Generally, it's for disasters such as, wildfires, hurricanes, floods, derechos, excessive heat, tornadoes, winter storms, qualifying drought, and then there's a few others plus related conditions that are the types of disasters that this assistance is available to help alleviate the impacts of. So we're going to have a little bit of alphabet soup here as I talk about all these that we've rolled out this year. ECAP, or the Emergency Commodity Assistance Program, sign up began in March and ended August 15th. This was direct payments for eligible commodities for the 2024 crop year. So it used certified acres and a flat rate by crop. Pre-filled applications were mailed to producers. And you can see how much went out to Nebraska. We were, I think, 5th or 6th, looks like, in the amount that was distributed through this program. Followed up by the Emergency Livestock Relief Program for drought and wildfire. Sign up began, as it says, in late May and ended here just a few weeks ago. This one helped producers who suffered eligible grazing losses due to drought or wildfire in 2023 and 2024. It used existing program information. So for producers who had successfully applied for the livestock forage program through FSA for grazing losses in 23 or 24 would have had some automated relief through this for this emergency livestock relief program as well. And as you can see, we had 67.5 million for 2023 when we had a little bit higher drought impacts for Nebraska, and then 2.8 million went out for Nebraska in 2024 for 2024 impacts. That program was also followed up with another iteration called the Emergency Livestock Relief Program for flooding and wildfire. We started sign up for that in mid-September, and again, that one ended just a couple of weeks ago. I don't have a public dashboard on payments yet for this program, but I will tell you for this one, it was mainly looking at impacts from hurricanes and large wildfires. So Nebraska maybe didn't have as big impacts for those two programs in 23 or 24. So we didn't have any counties that automatically qualified actually under this program. However, producers who did maybe had major wildfire impacts, for instance, or maybe flooding, could still talk to our office about applying to this program if they had documentation to show their impacts. Supplemental disaster relief program. We're working pretty hard on this one right now. Stage 1 was announced in July, and sign up doesn't end until April 30th, 2026. But the bulk of those payments likely would have went out already. And as you can see, we do have 434.8 million distributed in Nebraska already under that stage 1. It's for crops, trees, bushes, and vines, and it's actually more automated. So for producers who already had indemnified losses in 23 or 24, either through their crop insurance or through NAP for a qualifying disaster event, would have received applications that they would have completed and finished off with their county office to receive their payments under stage 1. Stage 2 was just announced on November 24th. So right after we got back from the shutdown. Application period goes through April 30th, 2026. So we're actively working with producers on this sign up right now. So this is for producers of crops, trees, bushes, and vines who had non-indemnified losses or shallow losses that maybe didn't trigger crop insurance, uncovered or uninsured losses, and quality losses. So producers can contact our office if they fall into those categories to see if they qualify for a payment under SDRP stage 2. And again, they have till April 30th, 2026 to apply for SDRP stage 2 as well. For both of these, producers will receive 35% of their payment And then once that April 30th, 2026 deadline passes, there may be additional payments depending on how much money is left at that time. I also wanted to quickly mention the milk loss program that was announced the same time as SDRP stage 2. Sign up began, on that same time period, November 24th, and ends January 23rd, 2026. It's for dairies that had to dump or remove milk without compensation due to some sort of qualifying weather event in 23 or 24. I mentioned this because we did have some Nebraska counties, particularly in Northeast where some of the dairies are located, that did have some impacts in 2024. So hopefully those producers are working with their county office. And I know in most cases our county offices probably reached out to those dairies that they're aware of. So I wanted to note the Farmer Bridge Assistance Program. This one is brand new. The president announced it actually a week ago yesterday. So on the 8th of December. So for this program, we are waiting on more official information. What we've seen is basically what's been in the USDA news release on this. $12 billion with $11 billion for row crop and $1 billion set aside for specialty crops. It's going to have a uniform payment formula to cover a portion of losses that have been modeled using 2025 crop year information. Payments are supposed to be released by February 28th, 2026. I should note that we don't have information on application information yet at our county offices. We are waiting for that. The only thing we do know from a standpoint of a deadline is that producers should make sure that their 2025 acreage reporting is factual and accurate by 5 p.m. Eastern Time this Friday, December 19th. Most producers will have already worked with their county office earlier this year to complete their acreage reporting. So there's likely not anything that they need to do right now before that December 19th deadline. They likely have their acreage reporting already complete. But if they have questions about their acreage reporting, they should call their county office and just double check that. But I think most producers will have that done. And then once we get information on the application process, we'll be sure to send that information out through our normal media channels and through our direct email newsletters to producers. So speaking of communications, I just wanted to highlight a couple things. These are good places to go for more information. Farmers.gov has information from FSA, NRCS, and RMA combined and kind of broken out into categories for certain types of producers. So it's actually a pretty easy site to navigate. FSA.USDA.gov has FSA program information available only, excluding NRCS and RMA, so just FSA information. And then if you put a /NE on the back of that website address, you'll come to the Nebraska FSA website. We work really hard to keep the spotlights section on the front top of that homepage up to date. And so that's a great place to go if you're wondering about deadlines and other information. You can go to the Nebraska FSA webpage. And then I also wanted to mention the Gov Delivery or the farmers.gov newsletter that our county offices put out monthly. And then we also put one out from the state office here in Lincoln monthly. If you aren't subscribed to these, I would highly recommend you subscribe maybe to your county newsletter as well as the state office newsletter. It's a great place to learn about the important things that are going on at Nebraska FSA. Across the state, deadlines, program information, that type of thing, where we do our best to summarize what's available on a monthly basis. And just a quick slide to say, a note of who the state office leadership team is here based out of Lincoln. And then we do have our district directors based in the field that are responsible for overseeing county offices in the field. And with that, I believe I have covered my farm program slides. So I am going to go on mute and then let Kelly take over.
Thanks, Bobby. Actually, I'm going to jump on here, and thanks for running through the the farm program information for us and leading us off today. I just wanted to take a minute to say hello to everyone. My name is Justin Terry. As Bobby said, I'm located in the McCook office. I've been with FSA for 24 years now. All my time has been in McCook as a farm loan officer and a farm loan manager, and the last 4.5 or 5 years as a specialist. So I'm going to help with part of the presentation today, and we'll get whatever questions answered that you might have, or follow up with you if that's something we can't answer. You know, we're excited about the upcoming production year and our ability to partner with you as guaranteed lenders and help the producers of the state of Nebraska that need FSA assistance. So I'm going to start rolling through the slides here. Our structure is largely the same as it has been for the last couple of years, where we have 21 farm loan offices, and the farm loan offices on this map are notated by the green stars, and then it's color coded by the area that each of those farm loan offices covers. And there's 71 total FSA offices in the state, and so we divide that up by territories, which they can cover to kind of help with the workload. So those are the offices of the producer, you know, the producer's base, that where you would submit an application when that comes in, and then you would deal directly with that office in processing that. I'm happy to say that we have farm loan staff in all of our 21 offices. You know, there's some surrounding states that may not be that fortunate right now, and there are times where we have to shift work around a little bit, and we appreciate you as lenders, you know, working with our staff to do that, because largely it helps us process the loan requests quicker by shifting them around where there is loan officers that have the time to give immediate attention to your loan application. So we appreciate you working with us on that. And then I'm going to get right into the funding. As you know, the government was shut down for some days there after the start of the fiscal year, but the good thing about fiscal year 25 is that we ended up without a backlog of direct or guaranteed loans, which means that we were able to obligate and fund all the approved loans. For those of you that have been around a while, you know, it hasn't always been that way. If Congress doesn't appropriate enough funds, there's on occasion where we might have to have a waiting list for loan obligations. But the good news is that didn't happen. And with the reopening of the government, the Department of Agriculture had a full fiscal year appropriations approved, and so that will run us through September 30th. And way it looks like right now, we should have adequate funding for all guaranteed and direct loan requests, which is what we really like to see. Annually, we adjust the guaranteed loan limits for inflation. There's a formula that they use to adjust that, and you should have received notification from your local offices that on October 1st that was raised to $2,343,000 for combined guaranteed farm ownership and operating loans. And then as you factor in direct loans, you know, that limit will go up to $2,943,000. And if a producer happens to have an emergency loan, and you know, we speak in acronyms, you know, you're used to talking to government employees, so I'm going to try to avoid that without at least introducing them. So on this sheet, FO would be farm ownership, OL would be operating loan, EM is emergency loan. And there's a couple other acronyms in there that are less common. CL would be conservation loan, and SW is soil and water. the conservation loan and the soil and water, I don't believe we have any in the state of Nebraska. So just a FYI on that. So that is the loan limits where we're operating at those levels today. We also had released the farm and ranch planning prices for fiscal year 2026 recently, and hopefully you were able to get a copy of those from your local offices. And this is the livestock prices here. You know, we on the lower weight calves we're up $65 from where we were last year, and on the heavier side we're up about $60. And you know, our objective in setting these guideline prices is to not chase the highs or the lows of the market. It's really to be able to prepare cash flows that show long-term probability of success. So we're not going to be on a average, but definitely there are multiple years of markets that our farm loan staff and the state office go through and research and when they set these prices. So we're not at the market definitely here, but when we're making 7-year operating loans to producers for breeding livestock, we really can't be at the market where it is today. This is on choice steers and heifers, we're up $28 from where we were last year, and I think on cull cows and bulls we're up like $35. So we've set those up or increased those quite a bit. Here on our less used enterprises in the state, you know, we're up a nickel on feeder pigs and about $5 on cull cows and boars, and sheep and lambs are up a touch, and our milk's up 50 cents a hundredweight on where we're setting prices for our direct loans. Here on the crop side of things, you know, that was there's been a lot of movement here lately, and so we are down a quarter from where we were last year on wheat. Corn, we're up 10 cents, so we're going to be using $4.40 on yellow corn. We're going to be using $10.70 on soybeans, which is up 30 cents from where we were last year. You know, hay is a little less. Yeah, it looks like maybe $10 less than where we were last year on our guideline prices. And so we provide those as a a resource. For one, it's what we're going to be using when we're making direct loans to producers. So in cash flows, you can use multi-year program payments such as CRP, Conservation Reserve Program, and EQIP. I don't know that acronym, so I'm not going to even try. But those are multi-year payments, so we can verify those. We can include those in the cash flow. But when we use, or when there are payments for the agricultural risk coverage and price loss coverage that Bobby was just talking about a little bit ago, we're not going to use those in cash flows because those are already factored in to like how we're setting our guideline prices. So we wouldn't want those to be used. Now, some of the ad hoc programs that Bobby discussed in the ones that have come out recently and still to come with the bridge program, you know, those can be used if we're only working with an annual operating loan cash flow. We wouldn't want the ad hoc disaster programs to be used in a term loan cash flow, or what, you know, your FSA loan officer is going to call a typical year cash flow, because that's the ad hoc ones are only a one-time payment, and it's not guaranteed for the coming years. Now, how this comes down to guarantee loan applications is you can use the FSA guideline prices if you'd like. You're not required to, but you know, the prices that you are using need to be reasonable and defensible, and you need to provide documentation in the loan narrative of the prices that you're using. And ultimately, if you're using a a price that is not an FSA guideline price. We want it to be similar to what your bank would be using on non-guaranteed loans. You know, we don't want that to vary. So if you have bank established prices for your non-guaranteed customers, and that's what you're using on all that cash flow, you know, you identify that in the narrative, and then that should be your documentation on prices. If you choose to use FSA guidelines, that's fine too. And as I mentioned before, you know, that with our direct loans, we have lots of partnering opportunities, and that direct loans are money that FSA is loaning directly to farmers, you know, as opposed to guaranteed loans, which is loans that you're making. But we have done a very good job of partnering together, you all and us, in making these loans. And so some of the more common programs that we partner on are real estate loans. Now, our very maximum real estate loan is $600,000 for direct loans, and in the participation program, some people call it the 50-50, but the participation program, you know, right now our rate is 3.75% on a 40-year term. That interest rate is 2% below our regular rate with a floor of 2.5. In these loans and the direct down payment loan below that, FSA gives the bank first lien on the real estate. We would take the second lien. You know, it improves your equity position, and the lender portion can be made with or without a guarantee. So there's no specific requirement there. The down payment loan is specific to beginning farmers or underserved. Beginning farmer is a producer that has farm to ranch for less than 10 years. And the underserved producers would be limited to parties of a racial, ethnic, or gender prejudice recognized class. And in those, they would qualify for this the lowest real estate rate we have, which is 1.5% in December, or 1.75%. I'm sorry, in December. That's a 20-year loan. Now this loan has a kind of a specific limit as it's written right now of $300,150, and that is per loan, and that's statutory, and the way that Congress had ended up writing that. But there's other benefits by having a down payment loan, like they get to avoid some of FSA's additional collateral requirements, and if you do get a guarantee along with the bank portion, they're not charged a fee. So there are other caveats to that program that are beneficial to the producer. As we move to the direct operating loans, our limit remains at $400,000 right now. OL loans that can be made for the purchase of livestock equipment, and this is also the combined limit for our annual operating loans for seed, fertilizer, chemical, and regular inputs. Our rate right now is 4.625, and when I talk about our rates, our direct loan rates change the first of every month. But when a producer's direct loan is approved, it is fixed at that rate. And then if they close in a different month and the rate is lower, they actually get the lower of the two. We have a couple other specialty programs with less paperwork, I guess, as government paperwork goes. There's still paperwork involved. But for microloans, $50,000 for operating loans and $50,000 for farm ownership loans. Those are separate $50,000 limits, and so that's reduced underwriting on our part, and provides an avenue for people with less of a need. Another thing that we have is youth loans available for producers that are between the ages of 10 and 21, and they're trying to start out maybe they're under a supervised program of 4-H or FFA, and they want to start a project that also is at a 4.625% rate. And as you can see, the youth loan limit is $10,000 now. That for years and years that was $5,000, and that was recently increased. So that is available for youth now to obtain those loans, and that is our probably least amount of paperwork of anything that we do. It's not very cumbersome for them to obtain one of those. That was our direct loan program and the way we can partner on those. And now I'm going to get into the guaranteed loan making side of things. So really, we're gonna highlight some things that maybe that are missed throughout the year, and there haven't been a tremendous amount of changes. There have been some changes recently with guaranteed loans, but we're going to highlight some things for you that maybe we could see that have been missed. And one of the first things that we're going to talk about is eligibility, and there's different items of eligibility, and usually these are being checked off on the application, but there's certain requirements for prior debt forgiveness to the government that would affect a producer's eligibility. They have to not be delinquent on any federal debt, not have any outstanding federal judgments. They have to be a citizen or a qualified alien to be eligible to apply. They have to have the legal capacity to incur the obligation. That some of that can come down to age of majority in the state, with a guaranteed loan, and having the legal capacity to sign for themselves as an advocate. They have to have an acceptable credit history, and one of the things with you're signing on the application that their credit history is acceptable, and even if they've had problems, you can address that in the narrative in the past of what's changed or how you're working with them to overcome some of those maybe past credit history problems. And by signing the application, you're verifying that they're unable to obtain sufficient credit without a guarantee, and also that they haven't been convicted of planting or cultivating, growing controlled substances, and that is a 5-year term on that eligibility restriction. So one of the things that we commonly run into and maybe results in a question when an application comes in is the application needs to be made in the name of the actual operator. So if a farmer is going to own ground in a different name, like maybe they have an operating entity, but they're going to own ground as an individual, the application actually has to be in the name of the operating entity. So we want to make sure that is consistent. And if it's not, if it comes in, we're gonna consider the application incomplete until that's kind of ironed out. They do have to be owner operator of not larger than family size farm, and so that comes down to our mission and where we need to be on family size. And if you have any questions on the size specifically before you work up an application, I encourage you to call your local office and talk to them about it, and they can figure that all out with you. And one of the things that when we talk about being an operator, they need to represent themselves consistently between farm programs and farm loans. So if they're obtaining farm program payments, the disaster payments or ad hoc disaster payments through farm programs, they need to be applying consistently for their farm loans when that application's filled out. One of the things we run into sometimes is embedded entities, and there are certain restrictions on embedded entities. I encourage you to contact your FL farm loan office if you have questions on an embedded entity, because there's a certain level of ownership that they have to make there to be able to qualify as an eligible operator. And one of the things, and I've mentioned entities a couple times, is there's a couple different places for entities that they have to sign on the application. So that if the entity is the applicant, they're going to sign on Part O as the applicant. But then also in Part P, all the members of the entity have to sign in their individual capacity also as applicants or co-applicants for the loan. We do require that. And just to highlight, when I went through the different eligibility in a couple slides previously, this is Part E on the application, the FSA 2211 application for guarantee, and they changed this a couple years ago, and they added some true and false, indications here to make sure you read through these. They're not always all going to be true or always all going to be false, and it doesn't mean it's wrong, but make sure you read through those and you're answering those correctly. The part of the application that the applicant is going to sign, and I mentioned this before, so that the actual applicant is going to sign Part F. So if it's an entity, it needs to be a person that has the legal capacity to sign for the entity, and they need to sign as an entity representative, and then all the members would sign in Part P as co-signers in their individual capacity. These signatures do need to be obtained before we can approve a loan. I know that in years past, there may be some instances where we had maybe approved a loan and put on the conditional commitment that we needed to have a signed application before we issue the guarantee. But as the guidance stands from Washington, D.C. right now, we will not approve a loan prior to having a signed application. So just if that comes up, don't be surprised. And I appreciate working with the offices of obtaining those signatures, because I know I've had it come up a couple times already this fiscal year. Wanted to give a quick reminder that inspections are required before submitting an application, an initial inspection, and we want you to, the purpose is to assess the suitability of the farm or ranch. We want you to, provide a summary of the narrative or a summary of the inspection in the narrative. And the other thing is the environmental inspection, whether it's on the 851 or a similar form, that also needs to be done prior to approval of the guarantee. Now, those environmental inspections that you're due on real estate secured loans, they no longer have to be submitted to FSA. They need to be retained in your files. And then whenever we do a file review, we would then review that and make sure that there weren't any possible environmental problems. And then kind of the next slide, we expand a little bit on environmental. So part of the environmental process is that each producer or applicant needs to have a current AD 1026 on filed FSA, and that's highly erodible and wetland form that they're, and really to participate in any FSA program, they have to have that on file. And it's part of a complete application. So if we get an application back and we don't have one of those for one of the applicants, we'll work with you on that, or let you know that they need to get into the FSA office to sign one. And part of the application, the lender certifying that they believe that the producer meets all the environmental requirements. And for real estate security, you know, like I said before, the FSA 851 form can be used, or the American Society of Testing Materials questionnaire. That's the other similar type form that you could use. What we're wanting to verify here is that there's not like any environmental issues with the real estate security that could be a potential problem in a liquidation and have any negative effect on value of the real estate. That's largely that portion for your environmental. But there is other reasons where we would require environmental inspection, and that would be anytime that there's going to be any type of development, construction with ground disturbance below the plow layer. So it could be for construction of a building or maybe livestock facility. Those do require additional review by FSA, and our offices will help you work through those. And we're tied to this because the National Environmental Policy Act, it when we're using federal funds or allocating federal funds for any type of ground disturbance, we have to make sure that certain things aren't being disturbed, and it could be historical, archaeological, endangered species, different things like that. We'll help you work through that. Contact our offices if you have any questions on that, but it's really important that the producer knows that they don't start any of that dirt work or any of that project prior to the environmental review being done and the loan being approved, because it will actually affect our ability to approve the loan if any of that's done ahead of time and we can't complete our review. Again, reach out to your offices that you work with if you have any questions on that. The last thing that I'm going to cover here is the portion of the environmental, or the application that deals with the environmental. Again, read the question because it's written different than it once was with true and false. So they may not always be true answers. They may not always be false. Specifically in the number 8 there is highlighted, and it says this is not a livestock operation. So if the producer owns livestock, that would be a false answer. And then you would put the number of head and the type of livestock. So if you have if you have an application that was submitted that was wrong, the office should follow up with you and have that corrected. And that's just to verify the state quality water standards are being followed on that. So with that, I am going to pass things off to Kelly.
Thanks, Justin. I just want to jump on here quick and introduce myself again. My name is Kelly Woida. I am the Guaranteed Farm Loan Specialist here in the state office. I've been a specialist for the last 1.5 years, and I've been with FSA for almost 10 years. We're going to go through here just a couple more slides, and one of the handouts that was attached to the email that I sent this morning. We'll take probably a quick 5-minute break here. And then we will come back and wrap up and then do questions at the end, like Bobby stated. So we'll just keep on going here. Okay, a couple more reminders that we wanted to share with you on as you put loan packages together this next year for guarantees, is if you are considering refinancing or using any loan funds to refinance debt, and can those loan funds be used to increase working capital? If you are using guaranteed term operating loan funds, those loan funds can be used to increase working capital. The amount should be limited to working capital that's appropriate for the type of operation. Kind of a good area that we like to see is maybe 10%. 10 to 20% of their operating expenses is left as working capital. That should also be identified in the loan narrative. You won't hear us say that enough today of identifying stuff or documenting it in the loan narrative. So putting it in your loan narrative is very important. And then if you're going to use a farm ownership loan to refinance any debt, those loan funds cannot be used to increase working capital or inject cash as working capital. When we do refinance and use farm ownership loans, if the operation is left with working capital, that's different than a straight cash injection. So if you do submit a guaranteed FO app, we're going to use our source and use exhibit that we have, and we can help determine, is it a straight cash injection or are we leaving the operation with some working capital? So there is a little flexibility there, but just remember that there is no straight cash injection with farm ownership loans. Also with refinancing debt, as a lender, you do need to document in your loan narrative how the proposed refinancing is in the best interest of the applicant and how it will help improve the applicant's financial position. And you also want to discuss what the problems are that the operation has or how the applicant got to the point of needing refinancing. And then also describe in detail in your narrative what the applicant will do differently to ensure the success of the operation going forward after the refinance. Like I said before, the Nebraska Exhibit 7, that source and use, or something similar that shows what all needs to be paid and the source of funds available to help determine if a guaranteed loan amount is enough to refinance debt and other costs associated with it is a very useful tool that we're going to use here internally when we do process SEL and CLP applications where we do receive the balance sheet and cash flow. So if you have something like that, definitely use it to help you, help determine your loan amount. Otherwise, we're going to also be using it and we can help determine maybe you need to increase your loan because we're not covering enough debt. And then we also do want to caution you as lenders to against using our guaranteed loan program to refinance your own debt, just to transfer that risk to the of loss to the government. So we do have limited loan funds, and we don't want to just have you put all the risk on us, and then we're just constantly paying loss claims. So let's see. Okay, also on refinancing debt, which we're probably going to see a lot of this year, so we wanted to talk about it. But when you're looking at refinancing any debt, we want you to ensure and document in your narrative that rescheduling the loan and alternative payment schedules have been considered before requesting any new guarantee. We do have limited funds in refinancing debt that is already covered by a guarantee uses up those limited funds and could cause the borrower to pay a new guarantee fee. If FSA does receive a loan request, we're going to evaluate whether refinancing will improve the borrower's cash flow and likelihood of success, or if refinancing essentially is going to result in the same outcome as restructuring the loan. And we're not just going to refinance existing guaranteed loans with a new request, just to consolidate the debts into one loan. Interest rates. So interest rates, these can be either fixed or variable. You can charge different rates on your guaranteed and non-guaranteed portions. One can be fixed, one can be variable, or vice versa. If they're both variable, different rates are also acceptable. And then if you do use a variable rate, it just needs to be tied to an index or rate specifically agreed between you and your borrower. And then just also in accordance with what your normal practices are for your other non-guaranteed loans. Percentage of guarantees. So typically these are not going to exceed 90% of the loan amount. They could be less based on the credit risk. For CLP and PLP lenders, they're never going to be less than 80%. There are some exceptions. So for a guaranteed OL and FO, the guarantee will be issued at 95% if the sole purpose of the guarantee is to refinance a direct FSA loan. If only a portion of the guarantee loan is used to refinance a direct FSA loan, we're going to look at doing a weighted average. And we will do that calculation according to 2FLP subparagraph 196A. So that could also be an option. And then, you know, if the borrower does meet the definition of a beginning farmer or rancher, then we do look at doing that 95%. You may request in writing that the guarantee be issued at 90% to save the borrower some guarantee fees if that is the case. And then the last exception here is if a guaranteed OL is made to a farmer who farms land subject to the jurisdiction of an Indian tribe and whose land is secured by one or more security instruments that are subject to the jurisdiction of an Indian tribe. And I don't believe we have any here in Nebraska that I know of. Also, as a reminder, our guarantee fee is the loan amount times the guarantee percentage. So either 90, 95% times 1.5%, which is the rate that is established by FSA. This fee can be passed on to the borrower, or it can be included in the loan funds. Sometimes we've seen banks that split the fee with their borrowers. So there's a couple different options there of how that fee is paid. There is a couple instances where there's no fee that's charged. So loans where a majority of the funds are used to refinance an FSA direct loan, or loans to beginning or veteran farmers involved in the direct down payment loan program. So just note that only applicants who meet both of the following requirements will qualify for a waiver. They have to meet the definition of a beginning farmer according to 2FLP Exhibit 2 as of the date of the app, and as of the loan closing, they need to have an outstanding balance on a direct down payment FO loan, or have a direct down payment FO approved, but funding's not available. And we do have funding right now. So that comes into play a few times that we've had that. So also on fees, so these would be lender fees or your fees that you would charge to your borrower. You can charge loan fees that just a reminder that they're no greater than those charged to a non-guaranteed customer. And then you may not charge a fee greater than 1% of the loan amount for the life of the loan when a guaranteed loan is made in conjunction with one of those direct down payment FO loans. You also can charge late payment fees, but they are not going to be covered by your guarantee, and they will not be paid in the event of a loss claim. You can still charge them, however. And then just one of the closing reminders. So after we've approved a loan, issued the conditional commitment, you've closed your loans, you've sent everything back, we are going to go through that conditional commitment. Just make sure that you have met all the requirements before we do issue the loan guarantee. And one of the biggest things is the promissory note. So on your promissory notes, if it is for an entity, you want to make sure that the note is executed by all members who are authorized to sign for the entity and by all members of the entity as individuals. If we have a promissory note come back in and someone didn't sign as an individual, we're going to have you redo that and send that back to us before we'll issue that guarantee. Let's see. And then the other thing that's missed a lot is the highly erodible wetland language is required on those promissory notes also, and that language is found on the conditional commitment. It's outlined in part 12 there. and I think it's in italicized. So making sure that you have that language on your promissory notes and security documents as well. Okay, Justin, could you pull up the processing checklist? One of the handouts that was attached to the email this morning is that Nebraska lender processing checklist. And maybe.
Technical difficulty.
There we go. Okay, this was attached to the email that you got from me this morning. It's the Nebraska guarantee lender processing checklist. This has been a guide that's kind of been around for a while. I'm not sure how long it's been in circulation. I did go through earlier this year and I updated it a little bit and added a little more description to some of the items. So Justin, if you want to go down to the second page there, you'll see that there's now it's broken into 3 separate checklists, one for each type of lender that you are. So if you're an SEL lender, looking at this first checklist, you're going to see everything that you need to submit for a guaranteed application. If it's grayed out, that means it's not required. And then if it says a Y, like on this first page, there's Ys. And then if you would go to like the second page where there's a CLP checklist, there's LFs, which mean loan file. So those items need to be maintained in your loan file. And then also on the side there, each submission requirement is numbered 1 through 19. And then in the following pages here, after the CLP one, there is a more description of what each of those items is. So for example, like the number 2 is the loan narrative, and there is a more explanation of what should be in your loan narrative. And it goes through each one of those. So if you are putting together an application, this is a good guide to follow. It does not proceed what is in 2FLP, so that is still procedure. This is just basically that condensed into an easy to follow format and an easy reference guide for you just to print out and have available when putting those applications together. And then there is a PLP checklist towards the end, and then it does explain, it has some explanations too after that. So I highly suggest printing this out, keeping it handy this next year, and referring to it if you need to, or asking questions to your local office if you do have a question on something when you're putting an application together. Okay, Justin, you can go back to the slides. The other handout that we're not going to go over or anything, it's just attached for your reference, is that 2FLP Exhibit 4.5, which is our lender's loan narrative. And can you give me control back too? Thank you. I do have a couple slides here that kind of break down, though, just the short version of what that exhibit says. But loan narratives, you can't hear this enough from us, are very important. They tell the story of the operation, especially if the borrower is not a current FSA borrower and we don't know anything about them. That's your opportunity to fill us in and tell us what's going on with the operation or what your loan request is about. So, that loan narrative should be an evaluation of the data that is related to the guaranteed loan request and not just a summary or restatement of what you provided if you did provide a balance sheet or cash flow, like go into the numbers. You also want to include discussion behind your numbers. So, for example, whether a number or ratio is strong or weak, depending on the type of farming operation and the state of the business cycle. You want to include your 5 C's of credit, discuss any deviations from history. And then, like I said, the level of detail is going to depend on if they're an existing FSA customer or not. And then the next couple of slides here are just kind of a breakdown of each of the sections. They're not all encompassing here on the slides. That exhibit 4.5 does go into more detail. It does have some examples in there of a write-up for some of the sections, but like a description of the operation, you should describe the overall farming operation, such as types of enterprises, the operating or legal structure, who the key personnel are. If the loan request is to refinance debt, are there any planned changes to the operation? Loan request, what type of loan it is, the amount, the term, the rate, what those loan funds are going to be used for, what is the guaranteed percentage that you're requesting. If it is, if they are a beginning farmer and you don't want the 95%, this is a good place to put that 90%, in that you don't want to incur more, costs to the borrower. Character and eligibility, just discuss the general knowledge that you have of the applicant and any history that you have with them and how they meet FSA guaranteed loan eligibility. You can also identify any like short, intermediate, long-term goals here. Your capacity and commodity prices. So this is going to be like a discussion of your cash flow analysis and how the typical year cash flow budget was developed. A reminder, a typical year cash flow is 1 year income to 1 year expenses. And then you also want to discuss any deviations in your planned cash flow that deviate from history. Describe how crop yields, calving, and death rates were derived based on history. And then also, like Justin said before when he was talking about prices, this is a good place to put, did you use FSA prices or did you use some other verified source of prices that you have. Capital, so discuss any of the applicant's financial conditions, include a discussion on any key ratios compared to internal standards that your bank has. You want to document strengths and weaknesses in the operation, and then address any non-essential assets if there is any. For collateral, this is a good place to summarize the lien position or identify any prior liens if that's the case. Assess the adequacy of your collateral that's being offered to secure the proposed loan. And then, if you did need to complete an appraisal or an evaluation, describe the method that was used to establish the market value of your security. Conditions, you can add in, your borrower's reporting requirements, any limitations or any other conditions that you're going to have for this particular loan. Would be a good place to put this if you feel like we need to know about it too. And again, these are not all encompassing list of what you want to include in your narrative. It's just a brief synopsis basically of here are the high level things that we would like to see and that we're looking for. But definitely that exhibit 4.5 as a resource too is a good place to look. Okay, and the last thing here before we take just a quick 5-minute break, and one thing we want to talk about is financial feasibility. So this is your, part of your lender's narrative, but it's also your cash flow budget that you're putting together for the operation. In the narrative, sometimes it does get overlooked and it lacks in detail of what we're looking for in your financial feasibility cash flow summary that you're telling us about. Especially if you're a PLP lender, we're not seeing that cash flow that you're putting together. So going through in your narrative and discussing it in depth really helps us. And it's just important that the proposed operation does have a feasible cash flow plan based on that typical year, which, like I said, is the 1 year's income to 1 year's expenses. That's how we look at cash flows here at FSA. The projected income and expenses for your operation, or for your borrower's operation, should be based on the applicant's financial history with any deviations from history discussed in your narrative. And we did talk about commodity prices, but including, the source of those prices that are used. And then in an instance where there's other income or alternative income that is being used and depended on for a feasible plan, that income should be likely to continue and also be documented as such in your narrative. So, okay. We'll go ahead and take a quick 5-minute break here. We'll get started back at 11:22. That should give everyone some time to run to the restroom real quick, and then we will finish up and we will end with questions here and hopefully be done around noonish. So
All right, this is Justin Terry again, and I'm going to go back and get started back up here on the rest of our slides. And just a reminder, if you do have a question, you can hit the Q&A icon in the top of your screen, type that in. We've got a couple that have come in, and we'll get to those here at the end. And next section I'm going to cover is in guaranteed loan security, and there has been a little bit of change on our definitions for adequate and removed definitions of like minimum and additional security if you're used to seeing something like that. So ultimately, the lender is responsible for making sure that we have enough collateral, that the security is more than the loan, and we want these loans to be secured similar to what your policy would be for non-guaranteed loans. And so with that comes, the example of like, if you have a non-guaranteed loan that you would require additional security on, we want you to do the same thing on the guaranteed loan, or how you propose that. With the collateral, it needs to secure the entire loan or line of credit. It can't be just a portion of it. And our recommendation is on operating loans is to cross collateralize all of those. We do also recommend that farm ownership loans only be secured by real estate, and we will probably hopefully contact you if you have personal property, or what we used to refer to as chattel security, as proposed collateral for a guaranteed farm ownership loan, because the last thing you want to do is have to track that for the entire life of a guaranteed farm ownership loan. The way the section of the form or the application form that you describe that in, we want you to be, I believe it's on page 2, we want you to be specific on what you're proposing as collateral, and identify any type of prior liens that there might be, because that there is certain restrictions on junior lien positions that we'll discuss in a minute. And when you talk about it in the narrative, there's a little bit of an example here of how you could identify, what you're proposing as collateral and how that would be handled with your internal lending policies for maybe non-guaranteed loans. And so, for SEL and CLP lenders, we want you to identify that in the narrative. PLP preferred lenders are going to be they're going to refer to their credit management system, which governs the way that they do each one of you does your write-up. And when I talk about the loan to value calculation, here's an example right out of our handbook that will provide you a link to where you can obtain the online handbook when you're done. And there used to be a couple different ways that we could calculate this depending on what we were doing. And with recent procedure changes, this is the only way we're calculating loan to value now. And so it's going to be the loan amount that for the guaranteed loan plus any prior liens divided by the entire amount of collateral. And it is important that we do it that way, because if you do the calculation the alternative way, it can increase it by a certain percentage points, and where it comes in to importance is when we're working with junior liens, because we have an 85% rule where if you're in a junior lien position, the loan has to be secured better than 85%. And this value is going to be based upon appraisals. We want to make sure that the prior lien doesn't have future advance clauses. And really, this is, there's other restrictions on junior liens, like for real estate loans, it's acceptable. For personal property or operating loans that are secured by personal property, it's only acceptable to have a junior lien if the prior lien is a debt with a different lender. So if it's a prior lien within your bank, we can't do that on personal property secured loans. Again, government regulations are complicated. If you have any questions, feel free, or I encourage you to contact your local office. When we talk about guaranteed loan servicing, we're going to go into some reminders here on servicing these debts. We want you to service the entire guaranteed loan and not just the portion that's non-guaranteed. And we want you to do it in a manner that you would any of your non-guaranteed loans. And we're going to want you to make sure that the loans are complying with all FSA program requirements. And as you can see today, we're just doing some highlights in our meeting this morning. There's lots of regulations. So if you ever have any questions, contact the office. We'll help you navigate your way through the rules. So some of the things that we're going to remind you of on supervision is we want to make sure that the loan funds aren't used for unauthorized purposes. That the borrower is maintaining compliance with your promissory note security instruments, like you would with any other loan, and with all applicable laws and regulations. We want you to take the payments, and if you have a guaranteed loan that's sold on the secondary market, make sure you're promptly dispersing the holder's share to them. And then also, we want you to provide or perform an annual analysis on this producer, just to review their progress throughout the year. And we're gonna have you, depending on your lender type, will depend upon how this analysis will go. For standard eligible lenders and certified lenders, we want you to perform this analysis within 90 days at the end of the operating cycle. There are this would be expected whenever the loans balances exceed $100,000, or if the loan balance is less than $100,000 and they're actually past due or in some type of financial distress, then we would like you to perform the analysis also and provide that based upon your lender type. And when I say lender type, for standard eligible lenders, they need to provide, like for real estate secured loans, balance sheet, farm visit report, income and expense statement, and and it's very similar for the term personal property. Lines of credit are a little bit different because we do require on standard eligible lenders that you request concurrence to advance on subsequent years' line of credit in writing. So those requests need to be sent to FSA with the balance sheet, farm inspection, income and expense, in the narrative of your review and of the producer. They need to be able to show that they can pay their line of credit to zero. It doesn't have to be paid to zero. They have to show the ability to pay it to zero. I want you to submit those to FSA so that we can review it, and then we would provide you as an SDL lender a letter concurring to advance on that line of credit during the 5-year term, when we're renewing the year. And at one time during the pandemic, this was all waived. It is no longer waived. This concurrence is needed. It is similar amount of work for a CLP lender. The big difference is on guaranteed lines of credit, certified lenders don't have to submit the financial documents. They just submit a statement saying that they've completed the annual review and that the borrower has the ability to pay the loan down to zero, and that they're going to renew or and start advancing on that line of credit for the subsequent years within that 5-year period. So that's one of the advantages of becoming a certified lender is you don't have to submit that financial information annually. It needs to be retained in your file, and then whenever a file review is done by FSA staff in your bank, they could review that information to make sure that that's being done properly. And for PO preferred lenders, we're going to have you follow your credit management system on how you do that, and you don't need to submit anything to FSA for review. That's the advantage of being a preferred lender, is there's less paperwork that's being submitted annually to FSA. A lot of these reminders, we provide in an effort to help you protect your guarantee in the very rare case that you need to execute it, or maybe you have a loss. Then we have everything that's been maintained along the way to stay within regulations. As a review of files, we listed a few common findings here that we can where we have seen across the state. We want to remind you on a guaranteed line of credit that you can't use those loans to refinance carryover debt. So any expenses from the prior year shouldn't be paid on a new guaranteed line of credit or any type of carryover there. And that would be true also for capital expenditures. Line of credits are not made for capital expenditures. We want those to be off the line of credit and termed out appropriately. And that one of the other things, and there's a note there that total dollar amount of advances and income can't exceed the estimated expenses less interest expense when we're looking at these on an annual basis. So keep that in mind when you're doing releases and monitoring guaranteed line of credits. So we want you to monitor all the security for the loan, and so when the loan is made, the lender's proposing a certain amount of collateral, and then all of that collateral has to be tracked for the life of the loan. So if it's breeding livestock on a term loan, we're going to want you to maintain those numbers. If it's machinery equipment on a term loan, if that machinery is traded or sold, it needs to be monitored and those funds used appropriately. If you ever have any collateral, or if you ever have any questions on that, again, feel free to ask your office on maintaining those numbers, or any type of issues that you might have with tracking collateral. One of the other things with servicing your guaranteed loans is the reporting requirements, and here's probably the biggest change that you're going to hear about today, maybe, is that the guaranteed farm loan status reports, the form FSA 2241, that used to be mailed to you semi-annually at the end of March, the end of September, are no longer being mailed out. So the way that FSA expects you to comply with this requirement is to remember twice a year to fill out this form and mail it into your appropriate FSA servicing office, or sign up for the online, the LINK program, another acronym I can't define for you, but it exists, and Kelly will tell you how to do that here later. You can submit those online, which may take some burden off on filling those paper ones out. That can also be done for the guaranteed loan default status report, the form FSA 2248. Now, that form needs to be done anytime the borrower becomes 30 days past due, and then resubmitted every 60 days until the default's cured. The important thing to note on specifically the 2248 is if you're using the LINK system to complete those, it is a good idea to contact your FSA office and let them know that that borrower is delinquent, because the way the software works, the local office does not get a notification that you've submitted that form. Now, once we know it, that the borrower is delinquent, we're going to monitor it, making sure that every 60 days, and probably shoot you a reminder if 60 days has transpired and we need an update to that. But just so you know, if you're using the link system, there's not like any automatic notification that we're getting that's a borrower's delinquent. So it just helps us out and our communication with you and what the potential resolutions to the delinquency are, or where we're going with it, and we can follow up after that. And then the last thing on reporting requirements, in the rare occasion that you have a loss claim, then you do have to, for 3 years following the payment of that final loss claim, file this Form 2261 and report on your collection activities with any type of liquidated accounts. And if you have any questions on that, please feel free to ask them. The last one of the last things here I have on servicing is interest rate changes after initial loan closing. As we see rates fall, maybe this will become more of an occurrence. And this really isn't a very difficult thing as far as government regulations go, because if you and the borrower agree to it, and if the loan's sold, if the holder can, either you buy the loan back or if you have written consent from the holder, it's really easy. You execute an amendment or a longe. You don't have to ask for permission from FSA. You just provide us a copy of that. And keep in mind that the new rate can't exceed the maximum allowable interest rate. And there's a specific calculation in our handbook at paragraph 135. Ask if you have a question of what that specific maximum rate is, and we'll let you know on that. And I think largely in the state of Nebraska, we're not having a problem staying under that. Yeah, because y'all are really competitive with your rates, so we appreciate that. And so, like I say, you submit that promissory note amendment to FSA, and that takes care of the interest rate change, and we will update our records on our end. The other changes that we did here recently is part of our streamlining and getting the job done is that we have a less frequent review schedule. So for SEL lenders, we're going to review 20% of your files on a 3-year basis, and for CLP and PLP, that will change to 20% over a 5-year basis. That is the end of my slides. I'm going to turn it back over to Kelly.
Thanks, Justin. Okay, just some other servicing actions that we wanted just to finish up here today with is partial releases. So you as a lender can release guaranteed loan security without FSA concurrence if the security item is going to be sold for market value and the proceeds are going to be applied to the loan in accordance with lien priorities. Or if the security item will be used as a trade-in or source of down payment funds for a like item that will be taken as security, or if the security item has no present or prospective value. Also on partial releases, so a partial release can be approved in writing by the agency upon written lender's request when proceeds are going to be used to make improvements to real estate that increases the value of the security, or if security other than significant income generating property will be released outright with no consideration, but the total unpaid balance of the guaranteed loan is less than or equal to 75% of the value of the security for the loan after the release, excluding the value of any growing crops or planned production based on a current appraisal of that security. So to talk a little bit more about that significant income generating property, will not be released without it being replaced. A significant income generating property is real or personal property that is collateral for a guaranteed loan and generates income that is necessary for the farming operation to achieve a feasible plan. So if you take the income that it produces, a lot of times what we see is real estate being requested to be released or partially released off of a guaranteed FO. So if you take that income that property or security produces out of the cash flow, and it results in a negative plan, then the property is going to be considered significant income generating. If the lender, if you can demonstrate that the property requested to be released will improve the borrower's profitability and the likelihood of success in the loan to value, with the remaining security meets a loan to value of 75% or less, and the loan funds are going to be used for an authorized purpose, and the borrower still maintains a feasible plan or cash flow, then the property could be potentially released as non-significant income generating property. If you do have a situation like this, please reach out to your local office or myself, and we can go through that. For partial releases, if you're an SEL or a CLP lender, you'll need to submit a current balance sheet and cash flow, an appraisal of the security, or potentially just an evaluation depending on the size or the amount of security being requested to be released, a description of the purpose of the release, and then any other information maybe that we would need depending on the proposed servicing action, which could include environmental. If you're a PLP lender, you'll want to refer to your lender's agreement in CMS. If it is not addressed in the CMS, then you'll just follow 2FLP paragraph 280. And like I said before, if you do have a situation like this, just reach out to the local office, and they will also help you walk through what you need to submit, or if you have any other questions on that. Let's see, servicing delinquent accounts. So just a reminder that a borrower is in default when they're 30 days past due on a payment. And then when a default occurs, you're expected to work with your borrower so that the loan can be brought current, or and the borrower continue their operation. This is just a little table that kind of shows a brief summary of a default, like if a loan was in default. Let's see, delinquent loan servicing. So if you have a borrower in default, you may not initiate foreclosure action on a loan until 60 calendar days after eligibility of the borrower to participate in interest assistance, and interest assistance currently is not funded. So therefore, if you are going to submit a 2248, you'll just mark that it was considered. You also want to continue to submit those FSA 2248's default status report every 60 calendar days until the default is resolved or a final loss claim is submitted. And then within 90 days of default, or 120 days after the payment due date, you as a lender need to decide whether to restructure or liquidate the account also. And then, as Justin said earlier, on those default status reports, if you're just putting them into the link system, assume that our office does not know that you put it in there if you haven't been in contact with them. So make sure you stay in contact with your local office. Some other debt servicing options is rescheduling, re-amortizing, deferrals, or debt write-downs. If you have either of those, please contact your local office to discuss them. For rescheduling or re-amortizing, just a reminder that FO loans can be amortized over the remaining term of the note or rescheduled with uneven payments over a period not to exceed 40 years from the date of the original note. If it's an operating loan or term loan, those can be rescheduled over a period not to exceed 15 years from the date of the rescheduling. And then lines of credit can be rescheduled over a period not to exceed 7 years from the date of the rescheduling or 10 years from the date of the original note, whichever is less. And then advances cannot be made against that line of credit if it's had any portion of the loan rescheduled. If you do reschedule or reamortize a note, you don't necessarily need to take a new note. If a new note is not taken and you just, modify the existing one with a note modification or an allonge, that's perfectly fine. But make sure that you do provide that to your local office so we can get that updated in our system. And then, like Justin said, on the interest rates, to make sure that those do meet the maximum interest rate requirements. And then the last thing there is you can capitalize any outstanding accrued interest, but any late payment fees or default interest can't be capitalized. If you are going to restructure a note, the borrower still needs to meet FSA eligibility. They need to, borrower's ability to amend the payment is documented by the following. If you're an SCL or a CLP lender, a feasible plan, current financial statements, verification of any non-farm income, verification of debts over 5,000, any credit reports, and then financial history and production history if you're an SCL lender for the past 3 years. It needs to also be submitted. Let's see, with restructuring, if any loans are secured by real estate, equipment, and or breeding livestock, they can be restructured using a balloon installment. You can capitalize any outstanding interest if a borrower is current but unable to make the payment. A restructure proposal may be submitted prior to the payment coming due. And then you want to also ensure that when you do restructure that your security position will not be adversely affected because of the restructure. And then also if you did sell it on the secondary market, just get in contact with that holder and make sure that they agree to any changes to the original terms of the loan. So if you're an SCL lender, you must obtain prior written approval from FSA for all restructuring options. CLP lenders can obtain written approval from FSA only for debt write-downs. So if you have a restructuring other than a debt write-down, you'll just need to provide FSA with written certification that each requirement in 2 FLP paragraph 312A has been met. Just a narrative outlining the circumstances and why the restructuring was needed, and any copies of any calculations that would help provide that information. If you're a PLP lender, you'll restructure loans in accordance with your lender's agreement and CMS, and then just attach a cover memo explaining the restructure. And then a reminder that all lenders need to submit copies of any restructured notes or lines of credit agreements or allonges to FSA. And then if you did submit a default status report, then you also need to submit a default status report to show that the FSA guaranteed loans are current now after the restructure. Okay, liquidation and bankruptcy. This table is right out of 2 FLP. If you have a loan that is in default and can't be cured after all loan servicing options have been considered, the table here is a good guideline for the next steps in the liquidation process. The table can be found in 2 FLP paragraph 355 for your reference to, and then all lenders, regardless of lender type, must follow the liquidation steps and timelines established by FSA. So the estimated loss claim process kind of has been simplified here. That's another one of the changes that came about here recently. And it includes you as a bank just submitting the form FSA 2254 guaranteed loan loss of report and a loan ledger. If you do have a loan that is in default and you're looking to submit an estimated loss claim, please reach out to your local office. or myself to talk about that before you do submit those, though. And we'll walk through the process before and just talk about everything. So bankruptcy, if you have a borrower who filed bankruptcy, make sure that you, as a lender, obtain a good bankruptcy attorney and protect the collateral that is security for the loan. That's the biggest thing. Some other reminders, like if you you should seek dismissal of a bankruptcy proceeding when the operation as proposed by the borrower to the bankruptcy court is not feasible. Make sure that you're monitoring confirmed plans under chapters 11, 12, and 13 to determine borrower compliance. And then just a rule of thumb, when you are working through a bankruptcy with a borrower, to not let the judge consolidate any guaranteed and unguaranteed debts. If they are consolidated in a bankruptcy, you're going to have to keep those separate and track them separately somehow. So keeping them separate right out, during the bankruptcy hearings and stuff, that would be the best case scenario. And then just make sure that you keep your local office regularly informed in writing if you do have a bankruptcy case. And then if you, like I said, if you submit that default status report and you don't contact us or let us know, just assume that we don't know that it was submitted in link. So just keep in contact regularly with your local office. And then just a reminder also, until the default is resolved or a final loss claim is paid, that you need to submit a default status report every 60 days. And then you can't keep us informed enough on any delinquencies or liquidation and bankruptcy cases. So, okay, to wrap things up here, just a couple more slides here on some resources that we do have. We do have that FSA.USDA.gov. If you select the programs and services, farm loans, there's a guaranteed loans lender toolkit. And on that lender toolkit, you'll find a link to our 2FLP handbook, which is the guaranteed loan making and loan servicing handbook that was referenced today. You'll also find some common guaranteed loan forms that are used, some examples of CMSs if you're looking to become a PLP lender. You can also access any past guaranteed lender trainings that are provided by the national office. Those are on there. There's an eForms site link on there too. We talked about interest rates and those maximum interest rates. There's links to the SOFR and the 5-year Treasury note rates there. And then that link access is there too, which is Lender Interactive Network Connect is what LINK stands for. We also have farmers.gov. Here we have like an online loan application portal for direct loans. So borrowers or potential borrowers can go in there and submit applications for direct loans. I think they're still working on an online loan application for guaranteed loans. There's a loan assistance tool there for potential borrowers. There's a guaranteed lender assistance tool that's available. And then you can also look up your local service centers. The Link network, we've talked about it here a little bit towards the end, but and Justin mentioned it when he was talking about, the semi-annual status reports. Those used to be mailed out. They're no longer being mailed out to each lender in the fall and spring ahead of the September 30th and March 31st deadlines. If you are signed up for Link, you will receive a reminder email that those are due. If you're not signed up for Link, you will not receive a reminder email from the Link system. And you'll either need to remember to submit them, or we're going to try probably and continue to send out email reminders from the state office here and from the county offices until we can get those, remember to submit those each year. So that's going to be a little bit of a change going forward of just trying to remember to submit those. So just be patient with us, and hopefully this next spring will go a little bit smoother, and we won't have a shutdown to follow the deadline either. So we'll be reaching out to you sooner if those are not submitted. And then with Link, so Link is a great system. It eliminates paper and mail transactions like we've talked about here on those semi-annual status and default status reports. It does save you time. So you can go in and you just enter your own information on each of your loans. And then you can also manage your status reports with one or more representatives from your lending institution. There's some Link user guides available on the guaranteed lender loan toolkit. So these are the 3 that are available. I highly suggest checking out that guaranteed lender toolkit. There's a lot of information on that website. And then some troubleshooting of Link. First, you have to confirm that you do have level 2 eAuth access. Once you have that, we will need your email address, level 2 eAuth ID, so whatever you use to gain that level 2 eAuth access, your phone number, bank name, and then the branch that you plan to submit a status report for. And those need to be sent, that information needs to be sent to Brandy Woida, and her information is here on one of the last slides. And she will need to get you connected in the Link system before you actually can log in. So once you have that level 2 eAuth, you're going to email her this information. She will do what she needs to do in Link, and then you should be able to log in. So if you have any questions with accessing Link or level 2 eAuth of how to obtain that or anything, there are quick reference guides available on our websites. And then you also could reach out to your local office or to Brandy or myself, and we can also help with that. And then the last thing here is, so everyone that attended today or on Thursday here has registered to obtain the training materials. So we do have your name for that. But if you are watching as a group, maybe you decided to watch as a group at your bank, just send an email of who all the participants were. If you didn't log in individually, just send them to Brandy Woida at brandy.woida@usda.gov. You can also email myself. And then if you would like a recording of this training, just let us know, reach out to Brandy or myself, and we can get the link to that for you. And then we just had a couple questions, I think, here in the chat that we did provide answers to, but one of the questions was, is an EIDL loan considered federal debt? And yes, it is considered a federal debt because it's a Small Business Administration economic injury disaster loan. So yes, that one is considered federal debt. And then the other question that someone emailed in is, are e-signed applications acceptable? And yes, they are acceptable. You just need to make sure that somewhere on your application, that if you use DocuSign or something, that DocuSign stamp is somewhere located on the application, and e-signatures are sufficient then. Or if your bank uses some other or sort of verification of your borrower that stamps it on the application, that works great. So other than that, I don't see any other questions. And we just want to thank you for attending the 25 annual Guaranteed Lender Update training. And if you do have any questions or anything that you want to discuss, reach out to your local office or myself or Justin. Our information is at the beginning, and we definitely can answer those questions for you too. Thank you.